And in our business stories, the UAE expects to issue a debt law this year that will allow the federal government to sell sovereign bonds in the future, according to officials from the Ministry of Finance. The ministry has been working on the federal debt law for years. Currently, individual emirates such as Abu Dhabi and Dubai have tapped the international bond markets. In April, Abu Dhabi raised $5 billion from the international debt markets, its first bond sale since 2009. Overall, GCC governments as well as related entities and companies have been ramping up bond sales in international markets. The UAE accounted for $14.4 billion issued in the second quarter, Qatar $9 billion and Oman $5 billion, according to a report in September from the Bank for International Settlements. The IMF has called on the UAE to tap bond markets and the assets of its sovereign wealth funds rather than draw down its local bank deposits to balance its budget. It is also forecasting that the UAE's cumulative fiscal deficit will reach $18.4 billion between 2016 and 21 as low oil prices reduce government income. As a result of expected higher debt issuance, the country's gross public debt to GDP ratio is forecast to rise 17% in 2017 from 16.6% at the end of 2015, the fund said. The UAE cabinet last year approved a 248 billion dirham federal budget for the next 5 years with a prime focus on education, social development and health. For 2017, expenditure is projected at 48.7 billion dirhams, leaving a negligible deficit. With the background of President Trump's election and a challenging year with elections in the European Union, global commodity markets will experience uncertainty and volatility that is unprecedented. That's according to Paresh Kotecha, the Managing Director of Richcomm Global Services. His opening remarks were made during the 4th Global Commodity Outlook Conference hosted by Richcomm Global Services and DMCC in association with DGCX and Thomson Reuters. Gathering over 400 renowned commodity experts from across the globe as well as government officials. The event was a platform to discuss the key drivers and constraints in the global commodity market currently. Meanwhile, Sanjeev Datta, director at DMCC, stated that internationally we start 2017 seeing the effects of volatile markets, modest global economic growth, uncertain outcomes of geopolitical conditions and shifting regulatory environments, adding that it is up to all those in the industry to meet these challenges by embracing them in a bid to ultimately strengthen confidence in the markets. Under the theme Changing Off the Guard, the event hosted 5 panel sessions discussing the outlook on the macroeconomy, energy, agriculture, base and precious metals, as well as the role of blockchain technology in the commodity market.
The major challenge or the larger picture is all about the entire commodity cycle, and we are amidst the challenging bit of that commodity cycle, and we're only going to see good things ahead. I always like to remain positive. Well, basically 2016 was a blend of turbulence as well as resurrection. 2017 will more focus on resurrection and consolidation, and that's the way I look at it. Geographically, it certainly is the tacit place to see throughput of commodities and create that commodity ecosystem, which is more specifically what DMCC is mandated to do. So we're in the middle of demand and supply for most commodities, fortunately. And I think we can only underline that presence and take it to the next level.
The main challenges I see for 2017 is the unpredictability, whether it's political, whether it's weather, whether it's supply and demand, whether it's China, whether it's the disintegration of the European zone. I think these challenges lead to the uncertainty, and I think these challenges are the reasons why we're here today. What we've done today on the 4th Global Commodity Outlook Conference is to gather some of the biggest experts from around the world and engage with them to find a solution and a strategy that suits us individually. So the challenges is really the uncertainty, the unpredictability, and even more so the speed at which the change is happening today. Commodity markets today are all based on relationships, and they have always been based on relationships, unlike financial markets, which are at a press of a button and an electronic screen. So what we're looking at here in this particular conference is to develop networks and relationships and an ecosystem in Dubai and create Dubai as a center of trading and as a hub.
Arabtec has announced a 1.5 billion dirham rights issue after the company announced widening annual losses this morning. In a statement to the Dubai financial market, Arabtec said it was planning its second offering in 3 years, alongside a capital reduction program which would reduce the company's share capital to lower balance sheet losses. Arabtec said the move, which has been fully underwritten by its biggest shareholder, Abu Dhabi-owned Abar Investments, was to secure the group's sustainable and successful future. The company plans to hold an annual General Assembly of shareholders in April to provide details of the proposal and win approval for it. Arabtec posted a net loss of 3.5 billion dirhams last year, compared with a net loss of 2.8 billion dirhams in 2015. The company said that the losses came as a result of impairment charges on high-risk items, as well as recurring, non-recurring and operational expenses. The company said its financial performance was a reflection of the adverse market conditions, which are having a negative impact on the construction industry throughout the GCC. Property brokers are forecasting that housing rents in Abu Dhabi look set to continue plunging for the first half of the year amid continuing economic uncertainty, job losses and cost-cutting measures. Chesterton's MENA revealed that villa rents in Abu Dhabi fell by 10% during 2016, while apartment rents fell by an average of 7%. During the final 3 months of 2016, the brokers said that apartment rents fell 1% compared with the previous quarter, while villa rents were down by an average of 2%. According to Chesterton's, rents fell in all of the freehold areas in Abu Dhabi during the final 3 months of 2016, apart from Al Dar's low-cost Al Ghadir development on the border with Dubai. Apartment rents in Al Reef downtown were subject to the biggest falls, slipping by an average of 3% between the end of September and December 2016, and by 11% during the year. Apartment rents in Al Raha Beach and Reem Island fell by an average of 8% during the year. Sales prices were also hit by the oil price downturn and job losses across the city. According to Chesterton's, prices for villas in the capital dropped by an average of 6% during 2016, while apartment prices fell by 3%. Last month, another broker, Core Seville's, predicted that house prices and rents would continue to decline at similar levels to last year. It calculated that values for prime and mid-prime villas fell by 15% during 2016, while apartment values were down 7%.